Boom, bang, fireworks. Trader's Edge.
All right, everybody.
Working on an intro.
Hey, welcome to episode 4 of the Trader's Edge with that high-tech intro. My name is Chris, known online as Don Corleone77, also known as the Godfather. I'm with my co-host, Kenny, who is known affectionately in the industry, with rightfully known as the grandfather of day trading, also known affectionately as Mashugana.
Yeah.
Some of us, right? So,
Hey.
all right, and we're here. Just a reminder, we have a lot to talk about tonight. We're doing this in the evening, by the way. But this podcast, just a reminder, and we'll state this on every podcast. Our goal, Kenny and I, what we're trying to do is for people who are interested in trading on a consistent basis, we want to teach you how to be profitable consistently over time as a trader, right? So to do that, what we've done, Kenny, been in the industry for over 3 decades. I think it's fair to call Kenny a professional. I also have been in this for a while. I also study professional traders. So what we do is we do what professionals do. And you're going to hear us talk about things like having an edge. When you go into trades, you're going to hear us talk about having a system. We're going to consistently talk about managing risk. All of these are principles that will hopefully distinguish you from other people who just are randomly going about things. Because the fact is, we know for a fact, there's statistics that tell us that 93% of quote unquote retail traders who try to become traders, people have committed themselves to try to become traders, not just everybody. These are people that have decided they want to be traders. 93% of them are gone within 5 years. So don't be part of that 93%, right? We're here to help you so that you're not one of them, right?
I like it.
And every week we're going to start with a joke, because if nothing else, you maybe hopefully get a few endorphins released, have a little fun here. That's our goal. We're going to teach you about how to become a better trader. And we're also going to talk about a few other things as well. Hopefully you'll enjoy spending time with me and Kenny. So here's a joke for tonight. All right. So Kenny doesn't even know this joke yet. So
it's already over my head. It's already over my head.
So there's 2 priests that are standing out in the road, and they're doing volunteer work. They're standing out there, and they're holding up signs. And this car comes driving by. You see the priest holding the signs, and the sign says, "The end is near." And the guy, puts his window down and starts yelling at him, "You religious fanatics, get out of here. I don't want to listen to you guys." And he speeds off. And then a couple seconds later, you hear screaming, "Ah!" And then the one priest turns to the other and he says, "I told you we should have had the sign say the bridge is out." That's the guy in the back laughing. I love it.
It's all done. It's all done. Well done. Well done.
All right. So let's get into, we talk about the meat and potatoes, and we're going to start out. It's a very interesting market right now. And I'm going to turn this over to Kenny. I mentioned Kenny's been in the industry for over 30 years. If anybody knows about markets, it's Kenny. So listen to what this guy has to tell you. He's like the Phil Rizzuto of commentary, and listen closely, because there are going to be things that he says that he just says off the cuff that are like really, really important for you to understand. So Kenny, tell us a little bit about what's going on with the markets. Maybe talk to us a little bit about some of these meteoric stock pumps that have been going on. Like what are you seeing happening going on now?
Yeah, I'm living the dream right now. I never thought we would have these days ever again. I never thought we would see stocks doing what they're doing on such a abundant in such an abundance. Once in a while you see a pump and dump. There's always out there, but since COVID, since the GameStop saga, we really have entered a whole new realm. And, each time this market, whatever the cause may be, self-induced crash from the tariffs or last year's fear of yen carry, the downturns are just so short-lived and so violently bought that you really don't even have a chance to get that dip where you probably should, and you'll wind up still chasing anyway. And then we're in a market that everybody's still a little bit nervous, which is good because that's the wall of worry. And that's where we're still at right now. I'm not worried, and I'm a bear. Again, this market to me looks like it is coiled spring ready to rip another 20% to 100%. And I mean it. And I'm a bear. And I've seen the signs that I've looked for to, glom on to some bearishness. And they've come and they've gone. They've come and they've gone. There is zero volatility. The volatility products are dead. And this is by far, I thought 96 to 2000 was something extraordinary. This is dwarfing that now, because what was amazing then is now an everyday occurrence now. So that amazing 18-month run that we had back in like 1998 to the mid of 2001, whatever it was, it was something unique. No one knew how to interpret that at the time either, because we never seen stocks going up in 20-point increments. Company would put out, an analyst would put out a buy recommendation and the stock would go there that day. That's kind of not how it works. But now we're seeing that kind of, repeating itself right now. And it used to make me more bearish because I would think this is getting too easy. And, that easiness to the market right now sets people up to thinking that it's going to be like this in perpetuity. And that's where you get hurt. And that's kind of what we want to talk a little bit about today, is how to prepare, or, at least have that in the back of your mind. For the day trader that I am, I welcome volatility. If the market crashes tomorrow, good. I'd be right there riding it down and then playing the bounce that would probably happen at the end of the day and whatnot. Volatility is great for the day trader because there's more opportunity, but the opportunity is abound anyway right now. So, we're going to talk a little bit about, because we come from different worlds. I live in the nucleus of the market as a day trader. Every tick matters to me. Every minute sometimes matters to me. And, taking advantage of what I see on a daily basis. Some of these stocks, or nowadays, most of the stocks, no idea what they are. We've got the micro strategy stocks that anytime I mention something about a Bitcoin treasury, the stock goes 1,000x. You mentioned AI, quantum. You mentioned anything with those buzzwords. The algorithms are glomming on, catching on to those. They're running the stock. They're hitting the message boards. And with these stocks that are, reverse stock splits and there's lack of liquidity out there, they're running some of these stocks. If you saw yesterday, we had one went from $1.50 to $80. And today we had, something that was absolutely insane. We had a $17 stock, which we were trading it at 16 and 17 bucks. I didn't even check what happened at the end of the day. It ran to 303. Yeah, 303, my friends, from 17 bucks. And that's in a day. Again, if I could show you this quick chart right now, which is just, let me see if I have it up here in the blink of an eye. But I just want to show you how these things just come out of nowhere. Well, that was the QMMM, right?
Yes,
Right.
correct.
So take a look at this chart for a second, my friends. And I'll put us aside. This whole trade, you see these red lines? That's where I was trading the stock. And, you got yourself a $14 stock that already ran to 32 bucks, which was pretty damn incredible. And then it came crashing back down, and you're thinking, all right, that's the end of this thing. And then, oh no, this is what you're looking at on my chart. Is the only thing I look at is the blue line is today's VWAP, orange line prior day VWAP. And then as it starts to accelerate above that blue line, that's a reason to buy. And that orange line is basically your reason to sell. So
Kenny, for our new viewers, can you just tell them what a VWAP is? A lot of people know, but we may have some new viewers viewing in that may not know what that is. So when you say VWAP, what are you talking about there?
yeah, sure, you got it. It's volume weighted average price. The only thing I use to trade now. I don't use any of this voodoo moving averages or stochastics, Bollinger Bands. I think it's all voodoo now. Since I've sworn my allegiance to VWAP in 2012 and just price action. So I just trade the actual price of the stock, and I put stops at just bottoms of candles, but I use volume weighted average price and multiple time frame VWAP to really keep me on the right side of the trade. And one of the things that I found as a shorter is that stocks do not want to stay down when they break back over the VWAP because it's an institutional buy signal. That's real money coming into the stock when it breaks over the VWAP. So if you're short, you're basically betting against the real money and you're going to lose. And that was one of the first lessons I had. And it took me a little bit of time to develop some of the best setups on that notion. And that's what I do now for a living. And I just trade basically stocks that are in play or in the news, and that's usually earnings or weird lunatic stocks like this. And again, it defines your risk with every trade. And again, that's why we're doing this podcast, is to kind of explain our edge. My edge is always having a trade where risk reward is in my favor. If I'm buying something or I'm shorting something, I know exactly where I'm getting out first if I'm wrong. I always prepare. I'm a pessimist. I guess that's because I have a Jewish mom, but I'm a very pessimistic guy. I prepare for, I hope for the best, prepare for the worst. That's how I was raised, and that's how I trade. So if I'm buying a stock at 17 bucks and the VWAP is, the prior VWAP is around 14, I know I'm risking 3 points on the trade. Normally it's a lot for a
So
three.
Kenny, if I understood what you said, just to make sure I'm clear and the viewers are clear. So VWAP is a metric very similar to like moving averages. Some people use RSI, Bollinger Bands, all these types of metrics.
Right.
You use a VWAP, the volume average weighted price.
Right.
And the reason you use that is because that tends to be a preferred metric for institutional buyers.
Correct.
Who are the big money people who are really moving the markets.
Correct.
So you've kind of learned how to exploit the VWAP.
Right.
And that's what you do, right?
I do, yeah. And it's also a nice reversionary tool for the shorter in me that loves to, short stocks. When a stock is gapped up way above VWAP, it tends that selling pressure that comes, and the algorithms that do tend to take profits on stocks that are gapped, you get a reversion trade back to the VWAP. And then as you establish a new, VWAP signature, as we call it, and it shuffles and jiggles at the VWAP, you can actually find a new trade in the middle of the day. And again, for us, we trade all day. I'm basically, again, it's 9 o'clock at night right now. I still haven't got up. And that's how riveted I am with this market right now. I can legitimately stay here and sit at this desk for 12 hours a day, and I'm still fascinated. After 30 years of doing this, absolutely flabbergasted and thrilled to be doing what I do. So, and again, being in the right place at the right time. And I'm not going to bullshit you. There's no way I'm in this thing till 3:03. But we had some members in our chat room that were involved in this thing up into the 60s, even into the hundreds. Because when these things start to go parabolic, you sometimes don't even have a chance to sell. That's how fast they're going up. And this thing got halted on the upside. So, for instance, if you bought this on that dip at like 120, it just spurted to 140 on a halt. And then the next halt, it opened up 30 points higher. So you had no choice but to make another 30 points on this trade. And then it got halted again at 220 and opened up at 270. It's just absolutely ridiculous. And I'll show you the other one, and we'll get back to just our silly looking faces. You had, Octo, which was one of these trades from yesterday.
That was yesterday.
And you had, this basically just came out, same kind of chart pattern. You're not thinking this thing's about to rip, but with I trade, every trade is exactly the same. I'm buying it on the VWAP break. The VWAP and the pivot points are my stops. And, sorry, I wasn't in this. I was over here. Around. Well, sorry.
You could put us aside, Kenny, pull up the chart. Maybe it'd be easier to see.
Yeah, sure. Here you go. And this one, it's just absolutely insane. It started in the early pre-market, but that was what was really interesting about it. Usually the pumps that get pumped in the pre-market, you'll have some selling when the market opens up. Not this bad boy. This thing ripped to about $57 from the $3. And then this is what I was talking about. Once you understand market mechanics and just simple chart analysis, you could see it. Tried to go down, tried to go down, tried to go down, tried to go down. When it starts to go up, those areas where it tried to go down are your stops. You could redefine your trade. And we wound up buying the stock right back here at $41, which was just like, I can't believe I'm buying this thing. And next thing you know, ripping to 46. I sold some at 46. And next thing you know, my target was just to see if it got back to the high of the day, and bang, it went right to $57. And, we sold it. And then crazy enough, and again, I was a little bit insane here. And again, I don't go crazy on these names because I know, inevitably they're going to be dumped just as hard. But even on just 100 shares, buying it on that break of $62, tacked on another 20 points. So just 100 shares, you're making 2 grand. Just absurd moves going on right now in the market. And it's. I think this used to make me bearish, but there's just nothing to be bearish about anymore. If you want to run stocks from $1 to 300 every day, let's go. Let's do it. Let's go, because I still got my edge. I know where I'm going to get stopped out at. And again, it's not like when people see these stocks, they're like, holy crap, you bought this thing at 58 bucks. What if it went back to $2? Not with me still in it. That's an irresponsible trader.
Yeah, Kenny, I think that's something to really make sure you're clear on. You're not going into these trades without a systematic approach and a
Absolutely.
mechanism to protect you, right? Because let's look at another example. Let's pull up CDW,
Oh my
which
God, yeah.
right now, if you're in this trade now, remember, we don't know how much experience viewers have, right? How much they've traded before, but this stock opened up and it went from where did it start the day, Kenny? A couple bucks, and it went as high as
Wait, it wasn't CDW. It was a different symbol.
no, it was CDW, I think. What is that one?
I think CDM. Or no, wait. I think we got it wrong. It's not CDW. CDM. I think your microphone's tweaking out.
CWD. CWD.
CWD. There you go.
CWD.
CWD. Yeah. And obviously you see this is what you normally see, folks. You pump and then you dump. And that's why it's fantastic to be a trader, because if you understand that the nature of these stocks is that there's just a limited supply, they get that, again, the GameStop saga continues. This is just collusion, right? Bunch of traders get together, they run it, spread some emails, get some FOMO going. The other algorithms catch on to it. Next thing you know, you get a stock that rips right from the VWAP here at $3 to 56 bucks. And again, with this one, I traded it on the short side because my advantage is way down there. Up here, I was going to short it there. I was a little scared because it was right at the open. But look at this. Even though I waited way down at 21.73 for my edge to show up, look at that price. That was a 7-point trade. So sure, I didn't short it at 44 and make 27 points. But when I knew that I had an advantage or an edge, I could short the VWAP and look at that beautiful retracement. And then it rolled over and just absolutely.
And this is really critical for our viewers, because a lot of them as retail traders, I know if they're not experienced, they don't know, like when you say this is typically what happens, a lot of people don't know that's typically what happens, right?
Yeah.
Pump and dump, right? They don't know. They're thinking, oh, this thing is flying and I'm missing out. And then they want to jump in and they have no systematic way of looking at it. And they get in at, 40 bucks or 50 bucks. And then the thing turns on you. And if you don't have a mechanism to prevent your losses, if you bought that thing at $50 today, I think it closed at like 7 or 8.
Yeah, you're done.
$7, right?
Right.
And if you don't have a stop in place, if you don't have a mechanism in place and a system, you're not going to recover from that for a long, long time, right?
Right. So imagine this is your first trade getting into the business, right?
Right.
Oh, and it's over, and it's gone.
And it's done, right? And you're like, I'm done with trading. I'm never going to trade again, right?
Well, here's another rule to understand pump and dumps. Generally, stocks, again, we're in a different realm now. I mean, I remember when 8% was great for a year. Stocks are generally moving in 5, 8, 12%, 20% all the time now. But if your stock is up about it, I've even seen decent stocks move 40 or 50% in this market. When you start looking at 80 and above, you're in that realm. Unless it was a drug, trial that went great, generally stocks that are up even 80% or 100% of the day, pump and dump. You got to be worried. That doesn't mean it can't go up from up 100% to 1,700%, or like we saw the other day. It's like it was just insane. Like these insane moves. But one of those those notions that it doesn't make sense to the layman that, hey man, this is great, stock's up 100%. Nah, normal stocks do not double in a day unless they got taken over or they had some sort of cancer breakthrough. And that still plays today. I mean, and that's why, again, the shorter, I love these stocks because then I know they're never really going to go back down. But damn, you better know what you're doing if you're going to get in the way of these freight trains.
And notice when Kenny was talking, that's why I said you got to really listen to Kenny, right? And he talks fast sometimes because he's got so much knowledge he's trying to share. He said, when he went into the stock, he looked at it earlier, he thought about it, but he was concerned because he didn't feel like he had an edge there, right? So what Kenny, as a professional trader, does, he goes into the trade and he disciplines himself to go in where he feels he has an edge, right? Otherwise, we're just gambling,
Yeah.
right? Then if you have no edge and you just buy something and you don't have anything telling you the probabilities in your favor, just put it on a football game, right? I mean, it's no different.
Right.
But that's not what professionals do, and that's why I want you to pay attention really closely when you listen to Kenny.
And I got to
Okay.
tell you something, again, like I said, I swear it's been over, since 2012 that I've, aligned myself with VWAP. And, over the last 13 years, I've really just honed in on the best ways to use it. Speaking of that edge, when you're, look how much I let, again, that stock fell 30 points where I got in, but, no, well, I forgot my point, but, yeah, the idea is that VWAP just alone, right, tells you that the game is over. Once these pump and dumps sink below the VWAP and then they try to get back over it, that's telling you the jig is up. People are moving on and you just got to get out of the stock. And if you let that happen to you, you're not trading accordingly. And this is what I was going to say, the analogy of the edge. So VWAP to me, it gives you such an edge that it's as if nothing's guaranteed, obviously, right? So when you walk into the casino, I don't know what game you play. Everybody likes blackjack because you're supposed to have a little bit more of an edge than every other game. Trading VWAP is like going to the roulette table and the pit boss says to you, "Come here, I like your face. For the next 20 minutes, only 5, 12, and 36 are going to hit. You got yourself an edge for the next half an hour, and you better make money in that time frame." So again, you wait for that setup, and again, that's what we're always trading. We're trading setups. You wait for that setup to give you the chances of having risk reward in your favor. Because if you were going to short some of these crazy names at the open, you don't know what's going to happen at the open. They could tack on another 500% right in your face, and you're done. Especially as a shorter, you have unlimited risk, and like you've said, no way are you predicting a stock that's going to go from $2 to 303. Imagine being short while that was happening. You're calling your family. You're saying goodbye. I thought I had a career. It's over. And then
Over in a day, right?
yeah,
Over in a day.
what's worse, the next day it's right back to $3, and you already took your ass.
That's right.
That's the worst. All right, let's move on from this stuff.
Well, no. I think that the thing to, and I want to just emphasize, like Kenny's when he talks about pattern. Like I use the term patterns.
Yeah,
He uses a different word, but he's been doing this for over, just using that VWAP for more than a decade. You got to understand. So what he's done is conditioned himself to look for the same patterns that replicate. And Kenny will tell you, there's one, and I watched him do it this week. I sat in Kenny's room. And I tell everybody, look, I've been doing this for a while myself. I have a fair amount of knowledge, but if I can learn from somebody, I'm gonna take every opportunity I can. And I've been listening in Kenny's room. I've been joining his room every day.
3
Right?
days of you being there, you gave us a trade with the
Yeah.
IoT. You spotted the chart. He saw the faux show, bro. And again, it's a fake out, shake out, breakout. I'll show it to you a couple more
Yeah.
1,000 times over.
And that's a pattern that Kenny recognized. He's one of the first guys, by the way. You got to understand this. He was on Wall Street at the time with a few other guys that they noticed this pattern that kept replicating over and over, a post-earnings pattern. And he terms it affectionately the faux show bro. And the pattern replicates when it comes up, it works about 90% of the time.
Right.
That's what we're talking about when we say an edge, right? When you go into a trade, if you're just buying something and you know nothing at all, and you have no analysis that you've done, let's just say you got a 50-50 chance. Let's just say, right? When you have a 90% chance of winning, right? Imagine getting dealt pocket aces on every hand. Pocket aces have an 85% chance of winning.
Right.
You got better than pocket aces every time you enter that trade.
Yeah.
And if you manage your trades right, like it's not going to work 100% of the time, but if you manage trades properly, if you're losing money when you have a 90% edge, then just get out. Just forget it. It's never going to work.
And to your point, you said the most important thing. risk management and money management, because I watched my son, who, he dipped his toe into trading. I showed him a little bit about what this was all about, and he had an amazing track record, right? So his win rate, he was 17 for 19 and somehow netted a loss for the month. He did 19 trades. The two that lost, he just didn't have the discipline to get out quick enough, and those two losses wiped out the other 17 gains. That's how most traders fail.
Yeah.
Because, and especially when you're on a streak, streaks are terrible. One of my mentor told me, don't ever count how many trades you're doing well in a row, because you're not going to want to break the streak, and you're going to not trade that. If you're on that 8th trade and, all right, I got 8 in a row, all right, here comes number 9. Your brain is going to try to keep that streak alive, and you might do something dumb to keep it alive. One of the things my mentor back in 1996 told me that, and I still think about that today. I don't even look at my P&L during the day. I don't think about streaks or anything. Every trade is exactly the same. Why am I buying it? What am I going to do if I'm wrong? And where do I think it's going? And that's it. Every single trade is exactly the same. And that's why it becomes very monotonous and redundant. And if you're making money doing something that's redundant, you're a winner, because it's the opposite of being insane. If you're losing money every day and you're not changing what you're doing, you're basically insane. That's the classic definition. So this is basically monotony and redundancies that just are, the casino is paying, and
I'd rather be monotonous and rich than taking a wild time and being poor. I'll tell you that.
Exactly.
All right, so let's move to the. Well, let me just mention one quick thing.
Yeah.
This is a caution, and Kenny, if you can pull up, there's a great book that I recommend everybody read, especially if you're a young person, and the book is called The Richest Man in Babylon. Okay, and I recommend every person. This should be like required read. I don't know why it's not required reading in school, but the one that says 5 Laws of Gold. So in the book, it talks about 5 laws of gold. And I just want to mention this because we're on this topic of these stocks that are going, meteoric rises, astronomical gains, 3,000% in a day, right?
Mm.
You got to be careful, right? Because, if you entered in, we mentioned that CWD trade. If you entered in that trade near the top today, you were going to end up getting crushed. And I just want to, I want to highlight 2 of these 5 laws. And I've followed these, to be honest, I read these laws, I read the book, I read it multiple times. And I can tell you this, in my lifetime, and I'm 60, the only times I've gotten massively hurt and it took me time to recover when I experienced a big loss is when I violated these laws. And there are 2 I wanted to point out in here, and then we'll move on. One is number 3, where it says, gold clingeth to the protection of the cautious owner who invests under the advice of men wise in its handling. And so when we talk about a guy like Kenny, you notice he said his mentor back in 1996, right? 30 years ago, listen to Kenny, listen to what he's telling you. That's the kind of person you want to listen to. There's a lot of people out there talking a lot of stuff, pumping a lot of stocks, trying to get you in so they can make money and get out. You want to put yourself under the advice of people wise in its handling. But the big one here in this topic is point 5. Gold flees from the man who forces it to impossible earnings, or who followeth the alluring advice of tricksters and schemers, or who trusts it in his, I can't read it, it's a little bit small, in its own inexperience and romantic desires in investment. So these ideas that you're going to make 100% a day, 200% a day, 500% in a day, 1,000% in a day, that's not normal, okay? That is not the way things typically work, and you have to understand that. And if you go into these things without experience, without knowledge, you can get crushed. And that's the unfortunate thing, because it happens to people, and then they leave the industry. They're one of the 93% that are out, and they think the market's rigged against them. Market's not rigged against you. You went into an area you didn't know about. You didn't have the counsel of wise people helping you, and you got crushed. That's what happened, right? So keep that in mind. I just wanted to mention that before we move on. Okay.
Does this work with silver? Because all I got is silver.
Yeah, silver. 5 laws of silver work the same, I think,
All
right?
right,
You
cool.
can apply it to silver.
Yeah, I was just buying some. I got some gold in the silver. How about that? You got.
Look at
By the way,
that.
if you like silver, we're gonna do another podcast. Now I know you guys love silver out there, you maniacs. I've been
I know you said that in one of the podcasts, and I've noticed other guys brought up, "Oh, I got silver. I got
yeah,
silver." Yeah.
we've been stacking since. I've been stacking since what is it? It's almost 10 years now. Jeez, man, time is just flying. I started buying silver about $15. So far so good. I think it's going to 80. So I buy every week. I buy every week.
I got to do a podcast on silver, Kenny.
They love the silver
Yeah.
bucks are out there. Oh, they love it. Lead it up.
All right, so Kenny, we're going to move on to the overall market. And I mentioned I spent the entire week in Kenny's room. It was fun. That's why I know now why they call him a Mashugana, because sometimes he talks, he's there talking himself, and we're listening. And there were times I was crying because I was laughing so hard. And I'm thinking, are other people laughing like I am? I'm like on the floor, tears are coming out of my eyes. It was pretty funny.
Thanks.
But after spending the week in the room with you, I noticed there were some things that you said over and over again, and I want you to kind of share them based on what you're seeing with the overall market right now.
Well, we were talking about earlier, this market again, I love it, and it takes a lot for me because deep inside, I'm waiting for the crash because this is just ridiculous. When I see stocks going up from $1 to 80, I look at that as being bearish. When I see stocks going from $13 to 330, to me, it's just like it's like we're beyond irrationally exuberant. We're psychotically exuberant.
Yeah.
Again, going back to the guy that taught me everything I know, and I wonder if he's still alive. I should try to find out. But he would just sit there and we would talk during lunch, and we'd go over my P&L and we'd look at some charts, and just like we're doing here, these little tidbits that he was just talking about. The dash for trash. I never knew what that meant. Being arrogant about your trades, not selling it all at one price. This all came from one guy. And it's just all that stuff plays out today. But the environment we're in, if you're a swinger or an investor, again, we're going to talk about ways that you could protect yourself. But right now, you just have to let it ride. You got to enjoy yourself. And for me, it's difficult because every day I'm like, all right, today's got to be the day. We're gonna give this back. This is gonna be a disaster. And the VWAP says, Kenny, you got to stop being bearish. Join in on the party, have some fun. And that's where we're at right now. That really just sums up this entire market. And that's why I'm bullish, because that worrisome notion there's something to it. It's called the wall of worry. So if everybody was super, super bullish, I'm perceiving it that way, but it's really not that way. More people are waiting for something bad to happen. And that's the wall of worry. And we generally climb the wall of worry. And considering that we've had, 2 real big monster crashes in a 365-day period, you generally don't get a third one. Even though they were weird, concocted fake crashes like the yen carry on August 5th of last year, and obviously tariff tantrum on August 9th, after May 12th, what I witnessed in the market, what was this called a power gap. After May 12th, I was like, whatever I'm thinking, I know I'm wrong. And it's hard to accept with your ego and just everything, because I know what I'm doing, and I have to convince myself to be bullish every day. And it's a tough endeavor because a lot of people can't do that. You have to say, okay, here I am wrong. Let me do the right thing. And that takes a huge mental effort. That's why when they talk about it, having a chart pattern that works, that's just a piece of the game. It's all in your head. It's all in your head. And that ego gets in the way. And you don't even know that it does. And you said something earlier about a preconceived notion of what's going to happen. Once again, I never heard that phrase before until my mentor said, don't come into a day with an idea of what you think is going to happen, because it's going to take your brain twice as long to realize you're wrong and then act on it. And I was like, that makes sense. And like I said, 30 years later, this guy, these whispers in my ear during lunch are just gems. And this is what I teach every day. And this is why we're doing what we're doing here.
There's a thing that's a whisper in my ear that I hear every day from being in your room. The reality of the market right now, again, if the market changes, we don't tell the market what to do, right?
yeah.
It can change. We know it can because historically it has. So, and that's what we're going to talk about in the rest of the show. But right now, like you said, the party's going on right now,
Oh yeah.
right? And there's a whisper I hear every night when I go to sleep now, and it says, shorting is short lived. And if you stay short, you're going to die.
Yeah, I've lived that life. That's why I came up. See, that one I came up with myself. Shorting is short lived, and you're gonna die.
If you stay short, you're going to die.
I have, I have, I've never blown up an account, and I'm proud to say that I've had to resurrect my career 3 times, and I'm talking about completely done. Wandering the streets of Manhattan, not telling my wife that I lost all of our money. My trading account was done. I had to go borrow money from Big Al, which was my dad. By the way, shout out to Big Al, still owns Oracle.
Yeah.
Big Al. I called him. I was like, "You still own Oracle, right?" He's like, "Yeah." Who is this? But
And by the way, Big Al's strategy, which is Kenny's father,
yeah,
has been, and it's a strategy. It's different than what we do. His strategy is to buy great companies and hold them.
yep, that's it.
And but he didn't do this for a living. Kenny and I do this for a living. But if you have a job and that's your strategy, buy great companies that you know are going to be around, that over time you believe are going to go up. That's a strategy,
Yeah,
and that's worked for Big Al, thankfully, right?
yeah,
Big Al's done pretty well.
yeah. And that again, like you said, even when I try to pitch him a stock, and I feel like I'm a broker when I call him, he's like, "I don't care what you got to say." I was like, "I'm sure it's a great idea. I'm good." And then I'm
Okay.
like, "No, seriously, this is a $2 stock. It might go to 50." He's like, "Great. I hope you bought it." And because he's so set in what he does.
Yeah.
And again, the guy's owned Q's since inception. Like I said, Oracle pretty much since the IPO. And he's a buyer on dips. He's owned Cisco, basically since 1998. And his price at one point was a loss. He was in the 30s and the 40s, and the stock went to $8.
Yeah.
Just bought
I mean,
more, waited it out, and next thing you know, it became a fantastic trade.
and if you have a job or another job, and you're doing this as like on the side as casual, and you're putting money away, you buy it over time and cost average. And if it's buy great companies, and that strategy works. But Kenny
Absolutely.
and I got to make a buck every day,
Yeah.
right? So we're trading every day. This is what we do. This is what we've chosen, and probably nobody would hire us in anything else anyway,
Yeah.
right? I know Kenny. I don't know about you, but nobody would hire me. So I got to do this. I got to make a buck doing it, right? So that's why we want you to consistently be making money in this thing. And then Kenny, so you're feeling right now again, kind of like you feel like this thing's going to keep going,
I
but
do.
even if it doesn't, since you're day trading every day using the VWAP, it doesn't really matter to you whether the market takes a big dip or not, right? That
Yeah.
doesn't affect you much, right?
I have my swing trades on. I don't ever call them investments because I'm not tied to these stocks. I just ride them as long as I feel like they are still going to go up. I've got my dribs and drabs of stocks that I own, but yeah, I would not be affected by a market crash. And again, I probably would enjoy it that day.
Hmm.
But also, more importantly, it's going to be short lived. So I welcome the sell off because there are stocks that I want to buy and I want to buy them cheaper. And I
Yeah.
would love to buy. I sold my Palantir after owning it for over almost 2 years, and I got out on the way up. I'm not saying I bought it all at $40 and sold it at 180. I sold 50, 80, 120, and then 150, and then 180. That was my plan. So when it hit 180, I was like, you know what? I mean, what am I holding on here for? This thing got to 180, even though I still think it's going to 250. So I would love to see Palantir get smashed down to $80 in a market correction or a crash, because then I'd buy it back. So I have my selfish desires here, but again, we need to talk about is the people that are fully invested. And I know that you're one of those guys who have a decent portfolio, and most people are that are maybe listening to the show. There are ways to protect yourself, and it's not about buying puts. You
So
know,
that's what we want to talk about. The final thing we want to talk about today, and then we're gonna close it. But so if you are someone, and what we've noticed, and just this is not doesn't require any genius. Most retail traders have a long bias, meaning they're holding stocks long, meaning they want them to go up, right? And most of them aren't trading in and out every day. They're buying stocks, hoping they go up. Kenny and I are pretty active online, so we know there are people, some people, you tell them, you give them information that might affect the stock, might have a negative impact on the stock. Potentially, they want to fight you because that's what they're doing is they're going in and then they're saying, all right, nobody's going to shake me out, right? Like I hear this diamond hands, right? I'm diamond. I don't care if the stock drops 10% or 20% or 40. You're not going to shake me out. And I'm like, all right, well, that's fine. If that's what you want to do, do that. I'm in this to make money. So if the stock's telling me it wants to go lower, I'm not going to diamond hand something that's going down, So do whatever you want to do. We just want to show you what we do. If you want to make money consistently and not experience catastrophic losses that are really hard to recover from, then these are the kind of things we want to make sure you're aware of. Okay. So with that said, the market has been flying, it has been ripping, no doubt, right? But we always recognize, and Kenny just said it, even though he has that positive bias right now, he feels like nothing's going to stop it. He knows if the market tells him something different, he's not going to try to change the market's idea. The market does what it wants to do, right? So with that said, we got a couple things that are about to happen, and all we want to do is make you aware of possible scenarios and make sure that we don't know what the market's going to do, but you have a plan in place in case any of these scenarios come into fruition. And you're not going to get shaken out during, when there's blood in the streets and people are panicking. You don't get shaken out, and then you don't have to experience big losses that are going to be difficult to recover from. Like, that's a big thing. And we want to make sure that you understand what's going on, because there are some possible scenarios, especially right now. There's a few things going on that we just want you to be aware of. One of them is, like, today, for people who follow the markets, today there was an employment revision. The BLS number was revised for the year, and they basically said that unemployment, there were over 900,000 less jobs created than they had reported. Okay. What is that telling us? It's telling us, Jamie Dimon came out today, who's the head of JP Morgan. He's the CEO of JP Morgan. Nobody really, what I say, what Don Corleone says, it's not going to impact the market, but something Jamie Dimon says, a lot of people are listening, right? And Jamie Dimon said, this is a sign the economy could be weakening. And that's the thing, right? This question, is the Fed going to cut rates? Why does Fed cut rates? Typically because the economy is weakening. It's a stimulative measure, right? It's a policy, a monetary policy to stimulate the economy, right? When it's slowing. So the question is, right, are we going to start to see a series of rate cuts? And if we are, what does that mean? We talked about this a little in episode 3. If you didn't watch episode 3, by the way, I think we'll have a link below, I think, where you can listen to episode 3. We talked about historically what happened with rate cuts in the past. And by the way, I'll take this while we're mentioning that. If you're liking what you hear, we're supposed to say this like everybody else, right? Then hit the like button, hit the subscribe button to Kenny's, hit the Bid Radio. I think we're supposed to say that. That's a requirement that we didn't do in the past, but we're going to do
soon. Hopefully, we're going to have an incentive to you liking and subscribing.
Yeah, we have something we're working on. So, all right. But what does that mean? So, normally they cut rates, but one thing you have to be aware of, that kind of there's a FOMC meeting coming up this month on the 17th, and it's almost a foregone conclusion they're going to do a rate cut, whether it's 25 basis points or 50. That's being debated, right? But we have 2 numbers that are coming out tomorrow and Thursday that have the potential, you just want to be aware, they have the potential to maybe throw a little bit of a wrench into it, right? And that's the PPI and CPI, the Producer Price Index and the Consumer Price Index. And if those numbers come in hot, there is a possibility, you just want to be aware, that it could put some pressure on the markets, okay? You got to be aware of that. Does it mean that the market's going to go down and it's going to crash? No. It could be temporary, it could be short-lived. Nobody knows, but you want to be aware so that you don't you don't want to be responding to something and panic and act out of fear and make a bad decision, right? So just be aware if those numbers come in hot, meaning inflation is showing more than expected, there is a possibility you might see pressure on the markets over the next few days. Don't panic, right? Just be aware and have a plan in place, okay? Let's say, though, the numbers come in okay in expectation, because if they are hot, we know Trump's going to fire the statisticians anyway. But let's just assume they come in consistent with the consensus.
By the way, shout out Peter Tosh coming in hot. That's what I had going in the background there. We're not allowed to play music on the podcast.
Oh, okay, got it.
Coming in hot. All right, now.
So if we do start seeing rate cuts, now there are going to be 3 meetings to the end of the year. Some people are assuming 1 rate cut. Some people are assuming 2 rate cuts. Some people are assuming 3 rate cuts. We don't know, right? And the Fed has told us they're going to be data dependent. So let's say we're going to have rate cuts. What does that mean? And this is the important thing, Kenny. We're talking about preconceptions. You could kind of pull any data you want to support whatever position you want, right? There's enough data out there. I could say, I want to build this argument. I can pull this data and support my argument, right? And I want to show one chart. Kenny, if you could put up the one that says Fed cuts near all-time highs.
You got it.
That's one a lot of people are using right now that I've seen, where people are going, we're near an all-time high. And whenever the Fed cuts near an all-time high, typically we see, maybe you could hide both you and me, Kenny, and make that bigger.
Sure.
When the Fed cuts near an all-time high, this is typically what happens. And you can see on the chart, it shows the next month, the next 3 months, the next 6 months, and the next year. And the thing a lot of people are pointing to is, and again, this is historical, if you look over the next year, when a Fed cuts near all-time highs, 100% of the time over the next 12 months, the market has gone up, okay? And it varied how much, depending on the market condition, what was going on, et cetera, right? But 100% of the time, you had a market gain over the next 12 months. So if you're in the camp that you want to support the argument, the market's going to go up, there you go. You got a piece of data. You can throw that out. You can argue with somebody, and you got a piece of data to tell you that. Okay,
incredible,
right? Pretty interesting, right?
Yeah, it's amazing, actually, 100% of the time.
Right. So here's another chart, though. If we pull up the inversion chart, this one I think is pretty compelling personally, right? I'm not saying I don't know what the market's going to do, but I'm preparing myself for any possible scenario. Okay.
What chart are we looking at?
The one that says inversion chart. So in this inversion chart, this tells a little bit of a different story.
Oh, I think
you got the one that says inversion chart?
Yeah, I got 10-year, I got constant maturity, I got treasuries, I got the black one, S&P falling apart. No, I don't have that one.
No. It says inversion chart on it. It says it's the one that shows the 2 and the 10s.
I've come ill prepared. I wasn't prepared for the test. I don't know where it went. Yeah, I don't have that one for us. You'll have to talk over it.
All right. Well, basically what happens in an inversion is where, you have bonds, right, that are sold based on durations, right? Typically, the longer the duration, the more interest you get on it. Now, that's a different chart.
Yeah, I don't have
okay. That's okay. I'll talk it through. So inversion, what you normally, when you have a longer term bond, you typically get paid a higher interest rate, right? That makes sense. But what you have is sometimes in the bond market, it inverts. That's what you hear called an inversion, right? And in an inversion, the shorter term bonds, the shorter term debt is paying a higher rate than the longer term debt, right? That's when they invert. And what happens is there are periods where, and we use a 2-year and 10-year notes when they invert, when the yield steepening comes out of the inversion, when it reverts back to the way it should. If we look at the last 4 recessions, I think the chart shows, if we were able to pull it up, you would see where we come out of the inversion, and that steepening out of that inversion, the last 4 recessions we had were preceded by that happening. And we're having that happen right now.
Hmm.
We're coming out of the inversion. Okay. And the chart would show you back in 2000, back in 2000 when we had the dot-com bubble burst, 2007, it shows you, and even during, I think even the recent periods where we went into recessionary periods, it was we were coming out of that inversion. Okay. And that's happening right now. It's a pretty compelling data point. You might want to just have that on your radar and say, okay, if we do, if it's signaling to us something could happen, have a plan, right? Don't be ignorant of it. Just have a plan. Don't say that's what's going to happen because it happened before. We don't know, but you know that it's possible, and you have a plan in place. The next one, the next chart, Kenny, it says GR chart. If you can pull that one up, that was the Great Recession, right? Back in 2007, 2009, and
Did I open up a different email? I think we're in the matrix here. I have your VIX. I've got your S&P.
I think you opened that was from the last time. So the one I sent you today, earlier today, had 5 charts in it. It was
Yeah,
the same email that had the one you had.
yeah, these are them.
Okay,
Here.
so there's one that says there's a Great Recession GR chart. It should be labeled
Yeah,
GR chart.
GR chart.
Yeah,
Yeah.
yeah. If you pull that one up, and that shows during the Great Recession what happened from 2007. Now again, different time, different market. Okay, but from October 2007, from the high to the where it where the market dropped. There you go. If you can make that a little bigger. So back in 2007, you can see from the peak to where it bottomed out in 2009. During that period, the drop was around 57%. Okay. And what this chart shows you is the Fed was cutting all the way down. Okay. So everybody, a lot of retail traders, they're like, okay, the Fed's going to cut rates. That means the market's going to go up. Does that mean that's exactly what's going to happen? Not necessarily, right? We have historical precedent that tells us the reason Fed cut rates is typically when the economy is weakening. And remember, it takes time for these interest rate cuts to work their way through the economy. It can typically take anywhere from 12 to 18 months for the rate cuts to work their way through. So what happens? The, the economy slows down, it weakens. What does that affect? It affects corporate earnings typically, and corporate earnings are what's going to drive the valuations in the market. So sometimes you have that period in between. So here you have it, 57% drop, right? While the Fed was cutting rates. So anybody who tells you every time the Fed cuts rates, the market goes up, you can tell them, that's not really true. And I'm not saying the market's going to drop 57% or 20%. I don't know what the market's going to do. Okay. But if the economy is weakening, just be aware this is a possibility and you have a plan in place in case this starts happening, right? Don't get caught off guard. Don't think you know what the market's going to do. That's the point.
Right.
Okay. And with that said, we'll close it with JP Morgan just came out. And again, this is an opinion. Doesn't mean the guy's right. Okay. But this is the JP Morgan analyst. He came out with a warning saying he thinks that this upcoming rate cut could be a quote unquote sell the news event. Right. So here's what he says, right? The trading desk says that the Fed's expected September 17th rate cut could spark a sell the news event, right? He says, despite the S&P's 30% rebound since April, when Trump paused the tariffs, right? We've had a 30% run. It's been pretty remarkable, right? He says risk from inflation, weak jobs, tariffs, and seasonal September weakness remain. And he says Morgan Stanley suggests hedging with VIX calls and adding gold, although history shows rate cuts outside recessions can still lift markets. Remember we pulled that first chart? that said what happens when you're near all-time highs and you
Mhm.
cut rates, right? So he's acknowledging that, but he's also saying we've got a lot of risks here. We've got risk of inflation. We got weak jobs happening. We don't know what's going on with the tariffs. I don't know if you guys how much you follow the news, but we're from this what we're doing today. After the market closed today, news came out that Donald Trump was suggesting to the EU that they should slap 100% tariffs on China and India because of what they're doing with Russia, right? If that happens, like that's a big deal. So you got to be aware that these things are out there, right? And what happens if inflation is hot? These numbers come in hot. Does that affect what the Fed's going to do the remainder of the year? It could have impacts on the market. So again, we're not telling you we know what the market's going to do. Do I know what the market? Absolutely not. I have
But I'll
no
tell
idea.
you what I'm not going to do. I'm not hedging buying VIX calls and gold. That is an awful, awful suggestion. That's just my opinion because
That's
VIX calls, if you don't nail it in the proper spot, you're still going to lose because the VIX is a reverting product. You might have a burst of volatility, but if you don't get that right, you're just going to
yeah,
wind up losing money. And
yeah.
buying gold,
I agree with you. I don't think the VIX call thing.
who's buying gold as a hedge? I mean, what is this, 1972? I mean, that's just one of the most awful suggestions ever. You want to hedge yourself, start selling in the money calls to protect yourself for some of these monstrous gains. That's how you really do it. And again, we were going to talk about this earlier. Like my dad, who doesn't hedge, the only thing he does do, because he doesn't want to buy puts. Because if he's going to buy a put on something, that means he thinks the stock is going to go down immediately. Why not just sell the stock? Or if you want to hold your stock, sell a deep in the money call that you take in some premium to offset that volatile moment. And if the stock market comes in and then goes sideways a little bit, that call that you sold at least takes some of the cushion or blows cushion some of the blow of the stock getting down. You understand what I'm saying, folks? Because if you buy a put, let's say you think something is going to happen, now you have to get your timing right. So you own a stock that you're up 40 points on. So now you're buying a slightly out of the money put. So let's say the stock comes down, but it comes down a week after your put expires. So what have you done? You just lost money. So if you think the market's going to come down, if you see it starts to come down, you really should sell just slightly, again, slightly in the money, sometimes out of the money, or depending on how much you want to hedge, sell the calls against the stock that you own, because there you don't have to get the timing right. The stock goes nowhere. You collect the money anyway. It's a win. Stock gets hammered. Some of that, all that money that the call is going to expire, you keep that money. And again, if nothing happens, you're just getting called out of a trade that you are taking a profit on. So it's a win-win-win. That's proper. I mean, this guy suggests.
And Kenny, I think if we start seeing the market maybe looking like it might correct,
Right.
maybe in the next episode you could elaborate on that a little further, because I know that I was quick because we're at the close here.
Sure.
And we kind of ran through some things, but maybe you could take the time to really elaborate and we can show people some examples of what to do in case that happens, right?
On that note, guess what, folks? You should come to hitthebid.com. I do 4 hours of commentary all day. Well, lately it's been 8 hours of commentary because I cannot pull myself away from the desk. So when that sell-off comes, baby, we'll be trading live. Unless it's some weird, crazy overnight, like on 2 August ago, where I got annihilated actually selling VIX calls. But that was an unprecedented event, and I took a beating that day because something happened that was no way predictable, and I just happened to be over leveraged at the time, and it was just a bad circumstance for me. And again, it's part of doing business. And again, that was a trade that I probably should have had on, and I learned my lesson the hard way, just like every other bad trade.
Hey, that's the point, right? We have rules. Sometimes we even think we know better, right? and that's why it's so important that you continue to, that's what the podcast, that's why we're doing this every week. And that's why we want you to get around people like Kenny. Hopefully, I'm getting ready to launch my site, I'll share with you more information about my edge. But we're following this thing every day. We're in this thing. We're consumed in it, and we want to share information to you so that you can learn from that experience, right? Kenny mentioned, over 3 decades, you get beat up quite a bit. You've had some experiences where he had to really recover from massive loss.
Yeah.
And he doesn't want to have, he's not going to go through that anymore because he's put protections in. And he doesn't want anybody else that he works with going through that, right? Nobody wants to.
I've never blown up on long trades because they can only go to zero, and
Right,
it's
right.
a very rare thing of stock to go all the way to zero. But
Yeah,
man, when you're short and you're over leveraged, the exposure that you're in, you start feeling some real pain and you have no choice but to get out of the trade because
yeah.
you're unlimited risk. That's no fun when the stock starts screaming against you. And as a shorter, I've experienced it way too many times. And again, that's why I'm in this position I am right now, because I'm feeling this. I'm feeling that those bears are still out there trying to bet against this market and they keep losing. That's what keeps it going up.
Yeah.
So when everybody jumps ship, maybe, or when everybody becomes bullish, like super bullish. And I'm again, we're kind of there. It feels like psychotic bullishness is all over, but it's really not that way. I've talked to money managers and they have their clients calling them saying, you got to get me 100% of this market. I got to participate. And they feel the fear of missing out is just so overwhelming compared to anybody's fear of the market going down, which I used to interpret as bearish,
Right, right.
but it just doesn't work anymore. So speaking of VIX, I watch the VIX every day, but I watch the UVIX and the UVXY. These are VIX products. They're derivatives of S&P put buying. They're built differently, and they're products that generally just trend down because there is no volatility. So when they perk up, that's a warning sign. And so far, they are just disintegrating every day.
So on that note, we're going to close it here. By the way, and there are people out there with different opinions. I watched something from Tom Lee today where he said he thinks Bitcoin will hit 200,000 by the end of the year. So all different kinds of opinions out there. It's interesting. We'll see. We'll circle back in December, see how that played out.
Right.
But again, point is, and that's the purpose, right? If you're in this market and you're trading the market, make sure you have an edge. Define what that edge is, and if you don't have an edge, guys like me and Kenny, just so you know, from my experience this week of being in Kenny's room, I typically am what's called a swing trader. I'm not 100% a day trader. I have long positions. I base them on an edge. I use data. I use information to establish my positions, and then I manage them. But I'm actually now kind of transitioning where I'm going to put a percentage of my portfolio into day trading using the VWAP like Kenny, because it works. So if you don't have an edge, stay with us, keep learning, keep studying, read people that are professionals. We're not the only ones out there, but you got to find trusted sources and you got to have a system to protect yourself. Risk management is one of the biggest principles that professionals use. You can't absorb losses that are just too hard to come back from.
Right.
And I'm a 60-year-old guy. I'm not going to go through that. You can lose, 2007, 2008. People lost. I have friends that were portfolio managers in their personal portfolios. They had the biggest names at the time, the equivalents of NVIDIA. Back then it was, Yahoo and other names. They lost 90% during that downturn. Their portfolio went down 90%.
I was there.
Okay. So
hey, listen, before we go, I know you let's give the kids a few ideas. I heard you were getting back into some nuclear stocks. Show me a couple before we leave.
I like the uranium space as a longer term play. I don't know how much I've talked about, but the idea of being asymmetrical risk, I think countries are moving. I posted today, by the way, if you go on either Stock, Twitch, or X, I posted a report by BMO Capital Markets where they talked about the uranium nuclear sector. So uranium used for nuclear energy, and countries are moving toward clean energy. The market is getting stronger. We're coming out of a more than a decade bear market, which is always good to come out of. And I like stocks. I like the space. I think we're still early. We're starting to see movement. Things have done really well since this past April. But I think there's more room to go.
I joined in. Are we talking about this one? I just bought it.
Which one is this?
You.
That's I bought that. I bought more today, this morning, pre-market. I think I sent you that today, right?
Yes, I joined you.
So that was up today. They also deal in rare earth minerals, and there was some news today. I like the stock. It's and now here's another thing. If this thing starts to escalate with Trump and Russia, right? The two big sources of uranium are Russia and Canada are really the two big sources of where uranium comes from.
Hmm.
And if that uranium supply from Russia gets impeded, it could get interesting,
Yeah.
right? But I think regardless, either way, long term, you have countries starting to use uranium, use nuclear, and now you have all these need for energy with all these data centers. And what are they doing? They're building what they call small modular reactors to provide energy because the amount of energy needed for AI is enormous, right? So this is a play. I still think it's early on. I think we're in kind of maybe, if you use a baseball analogy, we're maybe in the third or fourth inning. I think, and when you get into the late innings, folks, that's when the real momentum and FOMO players jump in. That's when it can really fly,
Right.
right?
That's why I like about this stock. This is all time highs, folks. So anytime a stock's breaking all time highs, that's under $15. Generally, they get to 15, and usually $15 stocks get into the 20s. Big fan, big fan. And again, this is just technically speaking. But when I saw this chart that the Dawn was showing me, again, I was looking at this thing getting back over 9, and I finally got in, about 11:40 because it was breaking highs, and then it broke all time highs. And now we got some news. I don't like buying into news-driven stocks,
Yeah.
but
News just maybe provides a little bit of a catalyst, but you're not buying news, right? You're buying, maybe if you're day trading and you think a news can spike it and you're going in and out, you can do that. But you're buying the narrative, right? And this is what you're looking at if you're looking to hold it longer term.
yeah, I like this on every time frame. And again, either long-term, short-term, midterm, it doesn't matter. I dig it. Yeah,
I added to one of the miners that you looked at before, DNN.
DNN, massive buying today. Yep, I was going to join you on this, but I'm kind of going to wait.
Gonna wait yet?
I want to
Right.
see it over 250 because that 250 number.
That's a big number.
A lot of people don't even look at stocks under 250. They're not marginable. Some people don't even look at stocks under 5.
Yep.
This can get something going over 250 and then get into that 450 range. $5 is where it came from way back in '08. Love this stock too. Yeah.
Look at those charts, folks. Just so you know, like that's what happened back in 2010, 2011. That's when Fukushima happened.
Right.
Nobody was doing nuclear. Nobody, right? All the mines were closed. You couldn't mine anymore. It was unprofitable.
Yeah.
So we're coming out of that. And I think that bottom there, down there, would you call that an Andy Dufresne?
Yeah. I mean, this
Right?
thing
Long Andy Dufresne,
dead
right?
money for got to be almost 5 or 6 years. Yeah. The longer they stay in that awful pattern and they come out. And again, we're kind of doing it again at a higher level between 150 and 250. That's why I think the 250 break is going to be pretty good.
That's a key that I identified. I agree with you 100%. I think 250 is a key point. Definitely a key point.
I like your names, and I'm on the other. I'm on some other stocks. Again, the stocks that I own are basically defense. I'm a warmonger, I guess. What are we calling it now? The Department of War, and I think that's what got some of these names going. Some of these stocks are actually out of Israel. Drone stocks out of Israel. I'm in this thing from 250, just broke all time highs. It's the mob. The only thing I don't like about it doesn't have options to hedge myself. Once they create options, I'm going to be getting involved. And there's a company called VWAP. And this is one of my favorite charts. This is a brand new stock, only been around for less than a year, and that's why it's so compelling because they had their news, and the whole existence of the stock has basically been inside this monstrous news candle, and it's tried to sell off and come back, tried to sell off and come back. You are $1 away from breaking all-time highs, and just like that other stocks that break 1250 tend to go to 15, and then you get something going. And then again, just like this whole craze, you never know which one of these stocks is about to go to 50, 80, or 120 when the lunatics on the message boards all jump on these ones. And this stock just created options, and they're pretty cheap for what this stock could do. So take a look at this V wave, and I'll leave you with that. I don't want to make
When
this
you say lunatics, that's like Meshuggahs, right?
Meshuggahs, yeah, those are the ones they'll and that's what we want. We want to buy before the Meshuggahs get involved.
Right.
Let them run it to 80 when we're still involved.
And one that Kenny and I both agree on, we'll close with this one.
Yeah.
I think we're both in it, is SRAD, right?
Loving the SRAD. Yeah. Big fan.
Look at that chart. I mean, yeah.
Phenomenal. Yeah. And if you want to see the lifetime on this one, and the reason I bought it was, again, I'm a sports gambler. This company is data aggregation. They help the FanDuels and the DraftKings with their live betting algorithms. And that's the space I wanted to be in. This is the stock I own the most of. And again, look at this. There's dead money for a while. That one line is why I bought it. Once it comes out of this was a lifetime VWAP. And look at the volume that happened, when it broke through there. And here you got the little Trump tariff moment, and that was another buying opportunity. And again, every consolidation has led to a buy. And again, in my world over the last 30 years, I've never seen a stock that looks like this that hasn't got the $50. So I'm in this one for the long term. And again, those red lines of where I bought, these where I bought some more, I bought some more, I bought some more, I bought some more. If I'm wrong about this, that's where I sell on the way back down. And like my mentor said, don't ever sell it all at once. No matter how negative you might get, you still got to let a stock breathe. Don't get out all at once, even when you're scared on the way down. Just don't sell it all at once. It's usually a mistake. All right.
All right, folks. Thanks again for your time. Please, again, don't forget to hit the like button, subscribe to Kenny's Hit the Bid radio channel, and we'll be back with you. We consider it a privilege that you give us your time, and stay with us. We got a lot more good episodes coming up, and thanks again.
Thanks for watching, guys. See ya. Good job.